Welcome to this lecture on financial technical analysis, focusing on momentum and contrarian strategies, crucial concepts for understanding market dynamics. We will explore the intuition behind these strategies, their practical application, common rules, and their respective strengths and weaknesses. Momentum strategies assume that assets which have been rising will continue to rise, and those falling will continue to fall, driven by trend persistence and information diffusion. Common rules include time series momentum, where you go long when the price is above its long look-back average, such as a 200-day simple moving average. Breakout momentum involves buying when price makes a new end-period high, like with Donchian channels, and exiting on a new end-period low. Signal confirmation often requires the price to be above a rising moving average, supported by volume or breadth indicators. Practical tips for momentum include using wider stops and smaller sizes during volatility spikes, and avoiding trades against higher time frame trends. Filters like RSI centerline 50 or MACD greater than 0 can be combined with momentum strategies to reduce whipsaws. Contrarian strategies, also known as mean reversion, assume that short-term price moves often overshoot and will revert toward an equilibrium. Common contrarian rules include band reversion, where you buy when the price falls below a lower band and sell when it rises above an upper band. RSI extremes are another signal, buying when RSI is below 30 in non-trending regimes and selling when it's above 70. Moving mean reversion involves fading intraday deviations that snap back towards the volume-weighted average price or a moving average. Contrarian strategies work best in range-bound regimes, so it's crucial to avoid strong trends or use smaller position sizes when trading against a trend. Regime detection filters, such as ADX or the slope of a 200-day SMA, can help determine if a market is trending or range-bound before applying contrarian rules. The runs test, also known as the Wald-Wolfowitz test, evaluates whether a binary sequence, like up or down days, is random. It counts the total number of runs, consecutive identical signs, to determine if there's evidence of trends or mean reversion. A large sample z-statistic is calculated and compared to a standard normal distribution. Few runs suggest trends or momentum, while many runs indicate mean reversion or noise. The runs test can be applied to recent windows, like 60 days, to diagnose the market regime, helping traders choose between momentum and contrarian rules. Momentum strategies capture persistent trends and align with institutional flows, but are vulnerable during regime changes and drawdowns when trends stall. Contrarian strategies profit from overreaction and liquidity demand, effective in range-bound markets, but are dangerous against strong trends and require tight risk control. Behaviorally, momentum is fueled by herding and overconfidence, while contrarian strategies capitalize on overreaction and sentiment effects. Understanding these strategies, their applications, and how to test them provides a robust framework for navigating financial markets. By combining these insights, you can develop more informed and adaptive trading approaches. Thank you for watching our lecture on financial technical analysis, focusing on momentum and contrarian strategies. See you at the next lecture.